specific developments. %18 YOY. Our loan growth was at 18% YOY, driven by 23% growth in retail, and corporate grew at 13% year-on-year. Our vehicle finance loan book grew 17% year-on-year, with full-year disbursements crossing 50,000 crore for the first time in our history. We had another strong quarter of business at Bharat Financial, with outstanding loan originated of 44,750 crores, growing at 10% quarter-on-quarter and 23% year-on-year. 43,750 is the loan outstanding. Our retail assets continued robust momentum with 9% quarter-on-quarter and 32% year-on-year growth. We aim to grow our other retail asset at a faster pace while improving the balance towards secured mix. We continue to scale up our new initiative with affluent grew by 24% year-on-year. NRI deposit grew by 33% year-on-year. Our digital platforms continue to show robust growth. Indi, the flagship digital platform for individual segment, is off to a strong start. And we now have 5 million install base and 1.2 million clients, with more than 9 million transactions being processed every month. On asset quality, we saw sequential improvement in asset quality, with slippages reducing across all segment units. Slippages for the quarter were at 0.44 versus 0.56 quarter-on-quarter. Full-year slippages were also lower at 2.08% versus 2.88% year-on-year. Credit costs for the year were at 113 basis points, well within our communicated expectation. We have maintained a healthy provision coverage ratio of 71% and carry a contingent buffer of rupees 100,000 crores outside PCR. Our profitability and capital adequacy. For the full year, financial year 24, our financial year 24 NII at 20,616 crores grew by 17%, while stable net margins at 4.26%. Our operating profit for the year was at 15,864 crores, grew by 10% year-on-year. Credit cost for the year moderated from 1.13% versus 1.37% year-on-year. Our net profit for the year was 8,977 crores, growing at 21% year-on-year with an EPS of 116 rupees. The financials were healthy for the quarter 4 as well. Our NII grew by 15% with NIM at 4.26% versus 4.28% YOY. Our PAT was at 2,349 crores, growing at 15% year-on-year. The annualized EPS was at 121 rupees per share. We continue to have healthy capital adequacy ratio with CET1 at 15.82% and CRAR at 17.23%. The board has recommended a dividend of rupees 16.5 per share for the shareholders. Our financial year 24 progress has largely been on track with our PC6 ambitions and across parameters. We remain committed to achieving our planning cycle 6 goals. We have shown healthy traction on all the key metrics and expect to show similar trends going into financial year 25 as well. Thank you, and we can now open up for question and answers.
I want to know regarding net interest margin. You have said that 4.26% is the current quarter number, but this is slight dip if you compare even on quarter-on-quarter or year-on-year. I want to know for the next year trajectory, you want you would like to aspire keeping it above 4%. What is your target?
So we've always set a range of net interest margin between 4.2 and 4.3. And we've always been in that range. You can't take a quarter or something as a thing and saying what has happened. It can fluctuate with the cost of deposits. So I think as long as we're between 4.2 to 4.3, we are maintaining our guidance on that.
Similarly, on deposit sides, you have mentioned it has been increased if you compare it with last year. Again, it is not just problem with one bank, but many banks are facing problem on raising deposits. What is your target for the current year in terms of raising deposit? Do you think there will be some pressure?
So I think deposits has been an issue with the liquidity remaining tight for the last 2 to 3 quarters. I think we've been able to manage well. We've grown 14% year on year on our deposits. We continue to believe that our retail growth of deposits will be higher and will match the asset growth. So we grew retail by 18% on the quarter. We continue to believe that we should be growing at 16 to 19% to match our asset growth ambitions of 18 to 22%.
Okay, last on your 56-44 ratio of corporate and wholesale. So what is your asset mix which you would like to continue? I mean, is it as per PC6? What is the guidance there?
So we don't give, we've always said our asset mix will be 55 to 58% retail and 42 to 45% corporate bank. And we've always done that. We've always been hedged towards that.
Sir, good evening, Piyush from FE. Sir, your OPEX is up 24% YOY. What is the core reason for that? Like Ankur sir was saying on deposits, CASA if we see Q on Q is down. So what are the drivers you are putting in? Because retail ones are coming but not CASA. So what are the levers you are putting in? And I just have one more.
So let me tell you, let me answer the second one first on the CASA, which is important. I think we are at 38% CASA ratio, and I think the whole industry has seen what we are seeing. Because the gap between the rates of deposit, which your interest rates which you're getting on the CASA or SA versus the term deposits, the spread widened. And I think people moved the money into the term deposits rather than on CASA. Going forward, if you see the last quarter also, we've grown our savings account by 7% quarter on quarter. It's the current account which has gone down. And I think you will see that our savings account continues to grow healthy. But our current account, I think there is a struggle which is happening on the current account, specifically because the large corporates where we don't have more than 10% lending, they get impacted, and the CASA as a consequence goes down there. We're focused on the MSME and the EC segment, which is the emerging corporate segment. And I think it's a slow and steady pace to replace that CASA. And it will take some time. And that's why the CASA is falling as a consequence. I believe that should come back. I think next year should be 38.5 to 39%. And then we will slowly take the journey forward. We've also launched a lot of initiatives to back it. I think we're working on one bank. So I think our vehicle finance as well as microfinance contribution towards the liability story has to increase. We believe that the bank has to differentiate itself in the offering. We believe community banking, specifically for us as a bank, has to be the differentiator going forward. And we believe we have 2 or 3 communities which we can make a huge impact. So for example, the Diamond, we are the largest financiers of Diamond. The Diamond community is about 1.5 to 2 million workers. And we believe it can easily take 5,000 to 8,000 crores of liabilities in the next 2 years in that business. We've launched a senior citizen program. And we believe that that's a very unique program which we are launching. And we believe we can believe 35 to 40,000 crores of additional liabilities which will come as a consequence of that. We've launched a woman entrepreneur program called V. And we believe that that's a very, very big community which we think can make a huge difference. So we are not going out in the market and saying just acquire a savings account. We are creating an ecosystem around communities, and we believe that's a unique proposition which we're going to come in various communities, and we will do that. That's number 3. Now, next, I think we believe that our approach towards branch expansion will continue. We are at 2,987 branches. We believe that we should go to about 3,500 branches in the next 2 years, and we'll continue to expand our branch network as we move along, because I believe that relationships belong to a branch and transactions belong to digital. And we will continue to do that. And last, we've launched IndusInd, our dynamic individual platform. And we believe that that's going to be a unique feature where a client acquisition run rate, which is about 1.2 million, 3.6 million today, 1.2 million today should go up to about 3.6 should go up to 5.6 to 6 million customers in a year. And I think that will itself, with engagement happening through the thing, I think we should be able to create a huge platform on the retail liability. Your first question was on OPEX. Now,
if you like this video, then like, share and subscribe to ET Now.